Affirm was a financial technology company that had one of the most anticipated initial public offerings, or IPOs, in 2021. But it also ended up being one of the most major bubbles in the market. Today, we are going to talk about Affirm. To say that investors on Wall Street were enthusiastic about a company is an exaggeration. They were successful in raising $1.2 billion at a price of $49 for each share. The price of the shares almost quickly climbed after trading began, eventually reaching $91 and roughly tripling in value from their previous level. The company did not also meet the demands that have been placed upon it up to this point. The value of a share has decreased by over 2/3 of its value ever since the IPO, and it is currently sold for $42, which is less than the initial launch price of $49. Right now, we will go through the performance of Affirm, why there was a lot of enthusiasm regarding their initial public offering, and the reasons why the firm did not meet the expectations. Welcome to Smart Stock Academy, where you'll discover videos about businesses and insights from your prominent CEOs. Thank you for joining us for today's video, and let's explore topics that will awaken your curiosity when it comes to stocks and investments. Make sure to like, share, subscribe, and click that notification bell to assure you that you'll be updated whenever we upload videos. Max Levchin, a former co-founder of PayPal, established this company, which is currently a leading company in the buy now, pay later sector. They offer loans known as installment loans, which allow customers to purchase items immediately and then pay for them in equal monthly installments over a period of months. It's a method for individuals to basically live above and beyond what they can afford. If there is a costly item that you want to buy but you don't have the money for it, you can use Affirm to delay the payments till your next salary in order to cover the cost of the item. Take, for instance, the scenario in which you are interested in purchasing a costly piece of technology but do not have the necessary funds. You have another option, which is to buy it on credit through Affirm with no initial payment required. If this company doesn't require interest, how can they increase their income? The interest that is charged on a bank's loans is primary source of revenue for a traditional bank. Let's imagine you buy a home for $300,000 and finance it with a 30-year mortgage. At the conclusion of the loan's term, you will have paid the bank significantly more than $300,000 total in interest and principal. This graphic illustrates how much you will pay out over the 30 years. You will make interest payments totaling $276,000 throughout the life of the mortgage, which is nearly equal to the value of the property you are financing. Even if the rate of interest is only moderately low, the cumulative cost can be significant. When you take out a loan through Affirm's Peloton option, you won't have to pay any interest. Affirm receives a fee from Peloton that is equivalent to the percent of the sales that are financed through Affirm. Affirm is compensated for taking on the riskiness and also their cost of financing through the fees that are charged to the merchant. By covering their clients' interest rates, Peloton is providing a form of indirect financial assistance to those customers. This is a part of an attempt that they are making to increase the number of sales of their items. There are various instances in which the merchant does not act as a subsidy for the interest rate. In such circumstances, the interest rate that Affirm will give you for the loan will range from 0% to 30%, determined by the total amount of the transaction, your credit score, and a variety of other issues. The interest rate on a loan often ranges between 15 and 20%. It is common knowledge that Americans spend an awful lot of money on useless consumption. The ratio of household debt to GDP in the United States is one of the highest in the world. Any service or item that makes it simpler to loan money and buy expenditures that are beyond one's financial means ought to see significant buying pressure in the United States. Affirm was seen as a new and advanced financial technology company by investors, which is why they caused the share price to double on a day of the initial public offering, or IPO. However, if you want to purchase something that is out of your price range, Affirm isn't the only choice offered to you. You also have the option of paying for it using a credit card and then paying off the balance of the bill at any time in the future that you choose. The national average for interest rates charged by credit cards in the United States is 20.5%, which is extremely close to the amount that is charged by Affirm. At first glance, it may not appear that Affirm is very unique or game-changing. To all intents and purposes, it is really a digital credit card that provides the end user with very identical economics. Yet, Affirm has indeed been able to achieve remarkable growth over the course of the past few years. During the time before the epidemic, they were able to process approximately $1.3 billion in gross merchandise value or GMV per quarter. GMV is the worth of the items for which they provide financing. This figure had over tripled to $4.4 billion by the time the fourth calendar quarter of 2021 rolled around. That is an outstanding indicator of development, and it is far more than the increase that the credit card industry had over the same time period. What sets Affirm apart from the competition then? The FICO score is given a great deal of weight by traditional credit card lenders. Credit agencies evaluate a consumer's creditworthiness by calculating their FICO score. This score ranges from 300 to 850. Your credit history has a significant impact on your credit score, also known as your FICO score. For instance, if you've ever had an auto loan or a home mortgage and you've already defaulted on either one of them, your FICO score will be really low. Even if you have never been late on a payment or defaulted on a loan before, if your credit score is too small, banks will consider you a questionable borrower and will reject your application for a credit card. If you're young and have little to no credit history, you might still have a low FICO score. This is especially true if you're applying for your first credit card. This will result in a low FICO score for you, or no score at all. If you want a credit score, you need to have some history of taking out loans. But if you don't have a credit score, you can't take out loans. Affirm claims that because they use a more holistic approach to evaluate credit risk than typical credit card companies do, they are able to approve 20% more applicants. They go beyond just looking at the FICO score when determining the likelihood of someone repaying their loan. Instead, they use artificial intelligence. Consider taking into account the kind of item the customer is looking to purchase as one illustration of this principle. For instance, if a client who has never taken out a loan before tries to get financing on $50,000 worth of accessories, it is highly likely that they intend to resell it on a marketplace and then default on a loan they took out to buy it in the first place. If, on the other hand, a customer is looking to purchase a $2,000 mattress, it is extremely unlikely that they have any intention of reselling it. They most likely just need it for themselves, and they have every intention of paying back the loan. A traditional credit card provider might not approve either of them if they had a short credit history, but Affirm might give the mattress buyer a credit card. One of the primary advantages of doing business with Affirm is the ability to extend credit to customers who has a lesser chance to apply on a loan. Additionally, in contrast to credit cards, they do not include late payments in their agreements. Affirm can more easily earn customers' trust in this way. If Affirm is truly an innovative fintech company with a superior value proposition, then why did the stock drop by far more 60% since the IPO, wiping out $20 billion worth of value for shareholders in the process? That all sounds great, but why has the stock dropped so much? It can be broken down into two primary justifications. To begin, the company was absurdly mispriced, and secondly, ever since the start of the pandemic, they have been subject to a substantial quantity of risk that is reflected on their financial statements. However, Affirm's net losses have skyrocketed despite the fact that their profits have increased by an astounding 160%. They did not make a profit, reporting a loss of $143 million despite having revenue of $361 million. This results in a negative net profit margin of 44%, which is awful by nearly any measure. As a result, they are undergoing the benefits of their expected increases by making massive investments in sales and marketing. Their budget for sales and marketing has increased by a factor of 20 over the same time period. In spite of the fact that their revenue has grown, the proportion of their earnings that comes from sales and marketing has risen to more than 40%. This raises the question, is Affirm expanding because their service is good, or are they expanding because they are quickly burning through the proceeds from their IPO to increase the employment of sales representatives to sign up new merchants? In the months that followed, investors who had participated in the initial public offering started paying attention to the growing quarterly losses. But when they declared partnership with Amazon in August of 2021, it seemed as though they had been rescued from their situation. As part of the agreement, users of Amazon will be able to use Affirm financing for the purchase of items with a price tag of more than $50. Amazon is by far the most successful e-commerce platform in the United States, with a gross merchandise value of over $600 million. Even with a collaboration with Amazon, the company was undoubtedly still overvalued when its share price reached a height of $164 per share. This was despite the fact that the firm's capacity to gain new clients was greatly enlarged as a result of this. During the financial year of 2022, a company's market cap was approximately $45 billion, the vast majority of which was attributable to the benefits received from Amazon. They anticipate bringing in a total revenue of $1.3 billion. Their worth is now almost 35 times their income, and despite this, they anticipate continuing to lose money. Discover, which is one of the most significant credit card firms in the United States, trades at a forward value to earnings multiple of 11 times, which represents a significant discount in comparison to the S&P 500. Its market cap is approximately 3 times its sales, which is significantly less than 1/10 of the firm's maximum multiple. Because of their high perceived levels of risk and their sensitivity to changes in the economy, financial institutions such as banks and credit card companies typically trade at a discount to the overall stock market. Many people are forced to give up their employment and fail on their loans when the economy is in a recession. For instance, the percentage of credit cards with outstanding balances rose from 4% to over 7% during the global financial crisis that began in 2008. That doesn't seem like a very significant amount. Many of the corporations that issue credit cards have significant amounts of debt. An increase in defaults of even a few percentage points could result in a company going bankrupt at the very least at its height. Affirm was awarded a premium valuation of 35 times their annual revenue by the stock market, which indicated that the market believed the company to be much less unsafe than traditional banks. But in comparison to existing banks, is Affirm actually more secure? The consumer loans held by Affirm on its financial statements are now valued at around $2.3 billion. They have borrowed around $1.6 billion worth of commercial borrowing in order to fund these loans. This bar chart presents Affirm's loan delinquency rate in percentage form. A borrower is considered delinquent on a payment when they are 30 days behind on their payments. Their incidence of juvenile delinquency varies from 1 year to the next, typically falling somewhere between 0.8 and 3%. Discover's typical delinquency rate in 2020 is depicted by the red line in this graph. Affirm's delinquency ratio looks to be roughly in line with that of Discover's. As a result, despite Affirm's powerful artificial intelligence systems to analyze credit risk, the company's loan portfolio appears to be quite similar to traditional credit card providers. Given that Affirm didn't exist during the Great Recession, it's impossible to say how well they would have fared. The only crisis they've ever been through was the coveted recession in 2020, which lasted only a few short months. Because of the enormous stimulus initiatives implemented by the government, the number of defaults did not significantly increase. A standard credit card provider like as Discover is not that dissimilar to Affirm when you get down to the nitty-gritty of things. They charge an interest rate of approximately 20% on loans made to individual customers. They keep these loans on their financial statements, which means that in the event of a severe economic downturn, their provisions for loan loss will shoot through the roof. The only thing that sets one company from another is that it prioritizes digital platforms in its business operations and spends hundreds of millions of dollars each year on marketing and sales in an effort to increase its revenue. There is a good chance that it will be many years before Affirm ever posts a net income or pays a dividend. When they went public with their offering in the beginning of 2021, the Federal Reserve was still adding stimulus money to the economy, and the growth stock market bubble was expanding. The Federal Reserve is getting ready to start increasing interest rates soon. This increases stress on any growth stocks that are losing money, including Affirm. That's it for today's video. Let us know what you think and leave it in the comments section so we'll know what your insights are. Again, make sure to like, share, subscribe, and click the notification bell for more updated videos about the business world.